Modern equity markets trace their origin back to an agreement signed under the buttonwood tree on Wall Street in 1792, but over time, these markets have become essential to Main Street as well. Companies all around the world need access and the ability to raise capital for job creation, to grow their businesses, and to innovate. Additionally, hardworking Americans rely on the capital markets to save for everything from college tuition to retirement. In 1975, Congress amended the Securities and Exchange Act of 1934 and directed the Securities and Exchange Commission to establish a national market system in which all orders to buy and sell securities would interact. Since that time, the structure of the U.S. equity markets has significantly evolved. Today's modern U.S. equity market structure has been shaped by 4 regulatory initiatives promulgated by the SEC. Order handling rules in 1996, regulation ATS in 1998, decimalization in 2000, and regulation NMS in 2005. Since 1975, there have been technological advances, as we all know, as we peer at our iPhones and other electronic devices. And today, a significant amount of trading is now performed by automated computer algorithms used by many different market participants. These participants include electronic market makers and high-frequency traders who seek to capture small profits from thousands of individual trades. These market participants also include large institutions seeking to accumulate significant positions without affecting the market. And they include broker-dealers seeking to provide retail investors with the best executions for their order. As trading has become increasingly automated, market activity is now measured in milliseconds and microseconds. By most objective measures, execution speeds, bid-ask spreads, trading costs, and market depth and liquidity, investors have benefited significantly from the development of more competitive equity markets and the rise of electronic trading. These improvements, however, do not mean that the current structure and operation of these markets is perfect. Some critics of the current market structure have pointed out that with around a dozen public exchanges and 50 alternative trading venues, today's equity markets are overly complex and fragmented. Others point to technical problems that have disrupted markets as evidence that the current market structure is not optimal. We all acknowledge that the U.S. equity markets are widely recognized for being the deepest, most liquid, and most competitive markets in the world. However, it doesn't mean that these markets are perfect and there is room for improvement. That is why a truly comprehensive review of equity market structure is long overdue. Today's hearing will review the current state of the U.S. equity markets and review how the current structure has evolved since the enactment of the Securities Act's amendments of 1975. We will hear from industry participants and experts on what is working well in today's equity markets, as well as areas that need improvement or are impacting the optimal functioning of the markets. In order to move markets forward, we need to know where they have been. As a Michigan member, we often talk in car analogies, and I'd like to say in order to look forward through the windshield, we first must take a glimpse in the rearview mirror. I look forward to hearing from our witnesses today, and the chair now recognizes the ranking member of the subcommittee, the gentleman.